One of the most innovative banks we cover currently is Aprila Bank. They reported their Q4 earnings on Monday, and for the first time they had costs below income. With us today is the CEO, Halvor Lande, who will present the bank and talk a little about the way going forward. I will return afterwards with a couple of questions. Until then, the floor is yours, Halvor.
Thank you, Vegard. So, Aprila Bank is a tech company with a banking license. Our business model is that we provide credit to small businesses in Norway using our own balance sheet and our own highly automated lending solutions for SMEs. And over time, we plan to make our technology available for large corporate banks internationally so that they can use our technology but their own balance sheet to give credit to their millions of small business customers who they're currently not able to serve. And we do this by developing highly automated solutions for customer onboarding and servicing, and very sophisticated machine learning models to accurately calculate risk and price in order to give the right loans to the right customers. And risk for small businesses is significant and varies a lot, so that's the big challenge to price that correctly. We do this by investing a lot in machine learning, and this enables us to give access to credit to a vast market of underserved small businesses with very low cost to serve. Our average cost to serve is about 1,000 kroner per customer per year. As a bank, this means that we will eventually become significantly more profitable than traditional banks while still growing fast. But equally important, this will be a big contribution to solve the SME funding gap, both in Norway and abroad. Only in Norway, we need 250,000 new jobs in the next decade in order to preserve welfare and manage the transition to a more sustainable economy. And 85% of all new jobs are created amongst small and medium-sized businesses. Every year, hundreds of profitable businesses go bankrupt due to temporary liquidity issues. Competitive SMEs are growing much slower than they could have because of capital restrictions. And tons of great businesses never get started by promising entrepreneurs who decide to remain in their cushy jobs in large corporates or public sector instead of venturing out to the capital-constrained young business environment. The fact that we have so the SME funding gap is important. It's an important problem to solve. The fact that we have an in-house tech team, we have a full banking license, means that we have high fixed costs, about 50 million kroner per year. And our loan tickets are quite small, on average 100,000 kroner per customer. So this means that we need a lot of customers, and it has taken us a long time to become profitable. The upside is that our variable costs are very, very low. So when we become profitable, we become extremely profitable. Going forward, I expect our cost base to grow at approximately 10 to 12% per year, whereas our total income is growing at 70 to 100% per year going forward. And this will already in 2024 give us a return after profit of more than 100 million kroner and increasing with a return on equity at more than 30% going forward. We have 3 products. Our first product was the spot factoring product. So this is basically the opportunity for small businesses to, inside their accounting system, once they have created an invoice and they have activated the Aprila integration, they immediately see the risk-based value of their invoice. And they can choose whether, and that's typically between 91 and 99% of the face value of the invoice, depending on the risk, the duration, the customer, if there is an existing customer relationship, and so on. And then they can choose whether they want to get that cash on their bank account right now, or they want to send out the invoice as usual and wait for the customer to pay. So basically a very simple and easy to use working capital solution. This is now available in 3 of the large cloud-based ERP systems in Norway: TrippelTex, e-accounting, and Fiken. And every time we've done a release in these big accounting systems, we get a massive surge of customers right away. But the growth has flattened out at around 3% of the user base in those systems. And we believe that the reason might be that this still is an early adopter product. It has not become mainstream yet. In addition, in 2020, Visma told us that they wanted to take over spot factoring and do it themselves on their own balance sheet. So we then decided that we definitely needed a new leg to stand on, and that's when we launched Credit Line, which is now our main, absolutely top product. Credit Line is a digital loan. It's available inside accounting systems, but it's also available on aprila.no. Any business any Norwegian business can come and apply for it. You can apply for between 50,000 up to 2 million kroner in credit line for your business. You find out how much you can get and what the monthly interest rate will be in 1 minute. So it's fully digital and automated. And it's also available in some of the other large Norwegian banks. For instance, DNB and Storebrand offer this to their customers. And this has been a big success, and the demand is just growing month by month. So this is what's driving our growth for the foreseeable future. The third product that we have launched together with Two, which is a Sequoia-funded Norwegian startup, is basically Klarna for businesses. So Klarna gives the opportunity for you as a private person to buy something and then get an invoice, buy something online and get an invoice instead of using your credit card. So this is exactly the same. You can buy something on behalf of your business and receive an invoice that you can pay later. And that's actually much more convenient for businesses, a more convenient way of buying stuff. Because it's easier to pay. You can pay it in your accounting system, and it's much easier to book it correctly in your accounting system. But it's still early days for the B2B commerce product, so it's we don't know yet how big of a success that will be. So why do we have this SME funding gap? There are lots of banks out there, right? And I believe there are 2 reasons. Reason number 1 is that traditional banks are using manual relationship-based processes to give credit to or to handle and process loans to small and medium-sized businesses. And that's a very slow and costly process, and the cost of that process is bigger than the expected profit from a small business loan. The other reason is that even though small businesses are 90% of all businesses, their total lending need is not that large compared to the retail market or the large corporate market. So it's actually a quite small market for the big banks. So it doesn't really make sense to invest a lot of automation to try to solve it like they've done for retail. But The SME credit market is very large. And if we compare it to the consumer finance market, for instance, it's almost twice as large, with the big difference that consumer finance and credit is a red ocean, lots of competition in a relatively smaller and actually Norway shrinking market, whereas the SME credit market, which is, in our opinion, a much more important problem to solve. I don't think easy access to credit for consumers is a problem that necessarily should be solved anymore than it already has been. Has much less competition, and it's still very, very much underserved. So that's a paradox. I think it has to do with the rise of the enormous success of the FANG companies, which has made consumer technology extremely sexy, and by parallel, consumer fintech is considered extremely sexy, whereas B2B technology, corporate fintech for small businesses is just not sexy. And for the banks, retail is a great market, and large corporate is a very sexy market. That's where the high bonuses are. That's where the wining and dining is. But small businesses for banks is not sexy. So this is a great opportunity with little competition as far as we see it. In Norway, 99% of all businesses are small or medium-sized businesses, around 470,000 SMEs. And the lending potential to that total SME market is several hundred million kroner. Sorry, several hundred billion kroner, of course. Aprila has become the leading actor for small businesses with less than 10 million kroner in revenues, which is about 90% of all businesses in Norway. And this is highly underserved market with a total lending potential in Norway of about 15 billion kroner. There's lots of talk from existing banks and new entrants about going after this market, but we have really not experienced any competition yet. And it's not surprising, given that it turns out to be very, very difficult, both to reach all these businesses and to calculate and price the risk correctly. And it's obviously also very high credit losses in this market. On average, the risk vary from customer to customer, but on average, we'll lose approximately 5% of the average loan every year, which is too much for most banks to handle. But in return, we take an average yield, which is a combination of interest rates and flat monthly fees of 249 kroner, of 249 kroner, and monthly interest rate from 1.5% or 0.7% to 2.5%, which gives us an average yield of 20% per year per customer, which means that our yield after losses on average is 15%, and combined with our low cost to serve, this gives us a marginal return on equity of 60% for every single new loan that we give. So as we take a larger and larger portion of this small business market, our return on equity, even with our capital requirements, will actually converge towards 60%, which is amazing. Very quickly about our Q4 result. Had a great fourth quarter. Total income tripled from 2020, and this was driven by strong customer growth, primarily in credit line, where we actually quadrupled the income from 2020 to 2021. And we are fully confident that the growth will continue and that we'll reach profitability that we will be profitable in 2020, starting from the second quarter this year. What is also cool to note is that our revenue growth has accelerated from total income growth from 116% from our first year of operation, 2019 to 2020, and 206% from 2020 to 2021. And that's driven by the growth in credit line, which is growing incredibly fast. And as Vegard mentioned, we finally, our total income has finally surpassed our total cost. So we are now already profitable before loan loss provision and realized losses. And as I said, going forward, we expect income to grow 70 to 100% per year, whereas costs will grow by 10 to 12% per year. So this is going to be a very fun ride. Thank you.
Thank you for a very nice presentation. There's a few points I would like to pick up on. You started doing spot financing, and then you pivoted into credit lines. What did you discover doing spot financing, and how did you discover the credit line product and the niche and the opportunity? And what, if any, of the models and systems that you developed for spot financing are you now utilizing for the credit line product?
Good question. So an important discovery for us when doing spot financing was that apparently the product, even though we think it's very simple and very brilliant, it was not that easy for customers to discover and understand. As I said, only 3% of everyone, the 140,000 businesses in Norway who has access to this now, has actually started using it. And from our spot factoring customers, we got feedback that sometimes they felt the price was high, and other times they said that they needed the liquidity, but they didn't have any invoices to sell. So it wasn't a perfect product from a customer, at least not for all customers. So that's when we decided to do, okay, let's just do a plain vanilla credit line product. That Kassekreditt in the region, that everybody knows what it is, right? And in terms of reusing models and so on from spot financing, well, the use case is actually quite different also from a credit risk perspective, because in spot financing, we're mostly concerned about the existing transaction history between our customer and their customer, and most importantly, the credit risk and payment ability of the end customer. Whereas for credit line, it's obviously the credit risk for our customer that is the most important. So we had to build new models. However, what spot financing has given us is a lot of data and a lot of experience with the dynamics and the types of risk in this small business market. So it's been hugely valuable experience and absolutely helped us understand how to build the product and made our first version of the probability of default models and so on much better than they would have been without that experience and that data.
And that's leads us over to another thing I've been wondering about, because your spot financing product, it has a very set duration for the product, whereas the credit line is very open-ended as far as I could tell, with the 249, the only payment you have each month. How are you then able to calculate and how are you able to calibrate your loan loss models? You used an estimate of 5% in your presentation. How are you arriving at that number?
So to answer the first question first, or first part of the question first, we don't only charge 249 kroner, we also charge the monthly interest rates. And both of these are charged not from the credit line, but from the current account of the customer, so which is a different account.
Okay.
So we notice immediately if the customer isn't able to pay the interest rate and monthly fee, and that's a big warning sign. And actually, what happens then is we close the credit line, so they cannot withdraw anymore. They cannot use the credit line to transfer to their current account in order to pay interest and monthly fees. And we give customer notification that their credit line has been closed. They need to make sure that they pay for them to continue using it. And if they haven't paid 2 months in a row, we transfer it to collections. Then it turns out that a lot of customers suddenly are able to find the means anyways, and then it rebounds back into everything okay. So it's not like if they're not able to pay 2 months in a row, they're definitely going bankrupt. That's not our experience.
No.
And then the other part, so 5% losses. That's basically what we're solving for, because we, to simplify a little bit, we try to price every loan, give them an interest rate that is equal to 4 times the expected loss of the loan. And as our probability of default and LGD model are becoming more and more sophisticated, we're able to, we can see already now that we're able to hit that more and more precisely. Yes, we have seen that the risk in the small business market is even higher than what we thought when we went into it. And that's why we've had to increase our prices a little bit, so that we actually remain at 25% losses as share of gross income. So I'm not entirely sure that the losses are going to be exactly 5%. And the yield is going to be exactly 20%, but I'm totally confident that the ratio between those numbers will be 1 to 4.
Oh, that's good. And you also state that one of the key elements that you're working with this year is to further optimize and automate your processes. With then the uncertainty around how loan losses really will turn out. Is there an issue or an uncertainty with automating more of this, or?
No, I think so. I'm sure that our automated process in the future will let through some customers that shouldn't have been let through. Because I don't think, or I think it's going to take many years until our machine learning models are as good as our chief credit officer in terms of really, spotting everything that might go wrong with the company. But I still believe that the effect of the automation will actually be to reduce loan losses. And the reason is that we're onboarding so many customers, and manual processes always has a risk for manual errors. And what the machine learning models are good at is actually looking at much more data than a human can, much quicker. So I believe from a quality perspective, our losses will actually be lower. That being said, we're only going to fully automatically onboard maybe over time, maybe a third, maybe 50% of our customers, all large tickets, and all sort of medium to high risk applications will be handled manually.
And then just changing topic a little. I was surprised by the cooperation with DNB, and especially how vocal DNB was about the cooperation afterwards. How did that cooperation come about?
So they contacted us, and asked if we wanted to collaborated with them on small businesses or small credit to small businesses. And then we discussed for a while, and we found out together that the best solution was for DNB to distribute Aprila, at least in the short term, distribute Aprila credit line to their small business customers. The reason why DNB did this is that DNB is just like us, very concerned about the SME funding gap. They know it's a big issue that small businesses are not getting access to credit. They also realize that it's actually a very difficult problem to solve from a technology perspective. And it doesn't make sense for them to invest all the time, people, and money that's required to actually solve that problem, because the total lending potential in the small business market in Norway is only 15 billion kroner, which is less than Visma's credit line in DNB. So it's peanuts, really. But it's important for the economy. It's important for DNB's 140,000 small business customers, and they want to be part of the solution, not part of the problem. So that's the background.
Yeah. Is it common for DNB to reach out to smaller other banks to cooperate with?
I don't think that has ever happened before, as far as I know. No.
If you look at Visma, and you mentioned it also in your presentation, a substantial amount of your spot financing customers will move, which you have through Visma, will move to Visma's own solution in Q2 this year. Are you afraid that the customers who are referenced by DNB, that DNB could do something of the same for those customers?
No, not really, for the reason that I just explained. It's not a positive business case for them to do it, as far as I can see. The exception is if they decided to license our technology, but use it on their own balance sheet. That's something that we might end up doing. It's basically a strategic and commercial discussion for both of us. That being said, I'm not concerned at all right now. DNB is still less than 2% of our customers, so it's not. It's not a concern.
And is it the same agreement, the same framework you have with Storebrand as with DNB?
Yeah, it's the same.
Is it possible to expand that and export it, if you like, to other banks?
Yes, absolutely.
And DNB and so on wouldn't object to that?
No, it's a non-exclusive agreement.
Okay.
Yeah.
And within DNB, is it possible to expand your cooperation with DNB in any way? You mentioned using their balance. Is there anything else you are discussing?
There are lots of other things we are discussing. We haven't decided on what the next steps are. One of the things that I think would be very exciting would be to do something together with DNB outside Norway. For instance, the B2B e-commerce with DNB as the lending balance and using our technology.
Yeah. Yeah, that would be very exciting.
Yeah.
That would be something we could probably discuss the next time you're here.
Yeah.